This show is sponsored by Interactive Investor, and you can save more money for your future with Interactive Investor's low flat fee. With most investment platforms, you pay a percentage of your pot, so the more you make, the more they take. But with II, you pay a flat monthly fee even as your investments grow. That means more money for your future. They have several accounts you can choose from, including an ISA, trading account, personal pension, and even a junior ISA. II has one of the widest ranges of investments on the market, with ready-made options for beginners and a wealth of tools for experienced investors. Visit ii.co.uk and join over 430,000 investors on the UK's #1 flat fee investment platform.
Hello and welcome to episode 487 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, welcome back. How are you doing?
Well, I'm doing okay, Andy. As people probably can hear from my voice, I've pulled myself from my sick bed. I always seem to get a cold during the Christmas sort of period every year. I don't know if it's to do with medicines I have for my Crohn's, my immune system gets suppressed always. So there's always going to be a podcast, if you listen to our show, around winter where I got a bit of a cold. But the show must go on, as they say, Andy. So what we're going to do is I'm going to be providing an outlook for 2025. So every year we do this. We have a look at what's happened in markets in the year that's just been, and then we talk about what are the predictions and what people are talking about are the main themes that we're going to see in 2025. Obviously, I will caveat this, that these are just predictions of what could come to pass. There's no guarantee that any of it will, but it's based upon insights from various investment banks and my own analysis. So take it with a pinch of salt as it's intended. Now, one thing we do every year, which is quite interesting, is to look at what the investment banks are predicting is going to happen with the S&P 500, so the main US stock market index, and where it will be at the end of the following year. So if we go back to last year, it's interesting to note that the average prediction, when you took a range of investment banks, was for the S&P 500 to rally 2.55% through the course of 2024. Well, as it turns out, the S&P 500, as I make this show, is up nearly 30%, and that is a huge difference. And what it does do is emphasize the potential for recency bias in investors' predictions or view of the market. So that means that what tends to happen is you put more weight on what's happened recently and you tend to project that into the future. So even professional investors do it. If you go back to the predictions that were made for 2021, 2022, and 2023, they were all heavily influenced by what had happened the previous year. So if you had a year where the market had tumbled, then the predictions from the investment banks were typically bearish, or they at least weren't as bullish as they would normally be. Because don't forget, when they make their predictions, they're going to put these out in the press and their customers are going to see it. So you're not going to want to say, if you're an investment bank, that the markets are going to collapse. That's not really good for business. So I'd argue they're always going to probably on the side of optimism. And in years in the past where we've had really strong years, then what tends to happen is that investors and investment banks tend to predict that the following year is going to be bullish, and their predictions are that bit more optimistic than they have been historically. Now, given that 2024 was such a good year for US equities, it probably doesn't come as a surprise that the average prediction for where the S&P 500 will end 2025, so in a year's time, is that it will be up about 9.67%. And in fact, of all of the various different predictions that I saw and analysed, not one of them predicted that the market would fall. So again, you've got to take that with a pinch of salt, because we had such a strong year in 2024. But it wasn't just US equities that performed strongly in 2024. As I look at it here on screen, we had the German DAX was up about 17%. Asian equities were up about 16%. Emerging markets were up around about 12%. The FTSE 100 up about 11%. The Nikkei 225, which is obviously in Japan, was up just over 9%. And the broader Euro First index, so the Euro First 300, was up about 7.5%. So there's quite a wide range of performance figures there. They were influenced by a number of factors. Now, if you take a helicopter view, you could argue that that list that I just read out goes from those countries that have new stable governments and perhaps have central banks that have turned more dovish and started cutting rates, all the way down to those economies that perhaps have unstable governments or where the central bank is that bit more hawkish or less dovish. So, for example, where we saw the European stock index get dragged down, that's because the CAC 40, so the French stock market, has performed disappointingly in 2024 compared to other European markets because obviously its government imploded. So we're seeing a big influence of politics in 2024, but also we saw the shift in monetary policy have a big impact as well. And they're both probably going to be significant factors in 2025 as well. We haven't got as many elections throughout the world as we had in 2024. And of course, we had the US election, which had a massive impact on markets. It will have an impact going into 2025. I'll talk about that in a second. But nonetheless, we are going to be talking about monetary policy at different central banks, I think, throughout 2025. So what are the key themes in 2025 then? Well, I'm going to give you some of them. If you want to know more, we've done a piece of research for AG20 investor members that actually lists and writes about a lot more of the themes that are possibly going to be key in 2025 with analysis. But I'm going to give you a bit of an overview of the main one. So perhaps the first one is going to be Donald Trump and the Trump trade 2.0. So a recent podcast, we talked about the potential impact of a Trump trade going into 2025. The reality is Donald Trump is going to have a huge impact on global politics, but also more than likely stock markets as well. So since the election, we've seen a wave of uncertainty, but also opportunity. We've seen the dollar strengthen about 3 to 4% against most other global currencies, which is an echo of what we saw in 2016. We've also seen US equities surge. We've seen financial stocks and consumers discretionary do particularly well. That's partly because of hopes of deregulation and potential policy changes. And also we've got that Elon Musk effect, obviously given his close relation with the incoming president. But we are likely to see bouts of volatility based upon what Trump says, particularly in relation to trade tariffs. Now, history suggests that in the lead up to the inauguration day in January, then it's really what happens in markets is influenced by what he says. But over the course of his tenure in office, then it's based upon what he actually does. So that will have a huge impact going forward. So it'll be less about what he says. That will cause probably bouts of volatility if we learn from the lessons of his first term in office. But then what he actually does and what he achieves will start to have more of an impact on what goes on in markets. And also, what we saw last time was that Chinese equities were one of the best performing sectors for UK investors during Trump's first term in office, which goes to show other factors actually have an impact on investment markets beyond just US politics. So one of the other themes we're going to probably be talking about a lot are trade wars and tariffs. So we've already heard from Donald Trump stating that he's going to be imposing a wave of tariffs on countries like Mexico, Canada, China, and even the BRIC nations. So things like Brazil, Russia, India, China. And there's even been talk of imposing 100% tariffs. Now, the problem with this is that we could see retaliation from those countries, but also it could start to cause inflation to pick up, particularly in the US, because despite what Trump says, if he increases the tariffs on goods or imposes new ones, it actually increases the cost of goods for US consumers and businesses. So that is inflationary. Of course, there's also the prospect of him spending money, or maybe there'll be tax cuts. All of these things can be inflationary. And it's not just in the US. We've got a similar issue in the UK. The new government laid out its spending plans in its recent budget, which has obviously concerned markets based upon how that's going to be paid for. So that is also potentially inflationary. So we're at this point now where another theme we're going to be talking about a hell of a lot in 2025 is inflation and whether interest rates are going to remain higher for longer. Now, on that point, if you go back a year ago, the market was predicting that the base rate would already be down as low as 4%. Well, as we now know, it's up at 4.75%. And that's because inflation has proved sticky. It hasn't fallen as quickly as many people had anticipated. And part of that is because of politics, but also because of geopolitics. So what's been going on in the Middle East, but also Ukraine. Now, I'll be showing a chart on screen for those who are watching this particular show that shows the predictions at the moment of where the market thinks the Bank of England base rate will be in the future. And in short, it is predicting that we're going to get down to around about 4% at the back end of 2025. So that will have a huge impact on mortgage rates, for example, but also rates for businesses that they can borrow at as well. Now, all of that leads quite nicely onto gold. And the reason is because 2024 was an amazing year for gold. At the time that we're making this particular show, it's rallied over 28% in 2024. And that's because of a combination of factors. So inflation concerns, the safe haven demand. So that's because of geopolitics, for example, and also because we saw a weaker US dollar at times throughout 2024. All of these things combined actually supported the gold price. So going into 2025, what's the likelihood that we could see further gains from gold? Now, I don't have a crystal ball, but if you look at the technical analysis that predicted the rally of this year, so if you go back and look at the long-term trends, there was something called a cup and handle formation that predicted the rally of this year. And we'll show that on screen. And also gold at the moment is still above an uptrend that's been going on throughout 2024. But even based on that analysis, there's likely to be a pullback in the short term. Doesn't mean there will be, but there is likely to be one because things can't go up exponentially forever. But also based upon that longer term technical analysis, it probably puts in a realistic high of around $3,000 per ounce for 2025. Now, that might prove true, it might not. But the point is, from where we are now, that is about a 12% upside on gold. So it's much more limited to what we saw in 2024. Now, moving on to some of the other themes for 2025, this roundup wouldn't be complete if I didn't mention artificial intelligence. Now, you'd have to have been really living in a cave if you haven't seen the AI stocks powering to new highs, anything from chip makers like Nvidia through to other companies that are investing in the future of AI, like Microsoft, for example. And they've been driving US stock markets to new all-time highs. But themselves, we've started to see more talk about the potential for a dot-com style crash. Now, of course, that could happen. It might not happen. But the reason people are talking about it is because if you look at the valuation metrics, so the forward price to earnings ratio, so that's when you look at the potential earnings of these companies versus the price of their stock, then for the prominent US listed AI companies, that's averaging around about 40 times. So if you look at that compared to the average for the wider S&P 500, then the forward PE ratio is around about 20. So that shows you how expensive these AI stocks are. That doesn't mean they're going to crash tomorrow, but when you see high valuations, it does increase the likelihood that we could see some kind of pullback. Now, one of the question marks going into 2025 is, will we see a bit more about the profitability of these companies that are investing a lot of money into AI? And if those profits don't materialize, or they are predicted to not materialize in the way that they are currently predicted to, then that could see a pullback in the value of those stocks, which will have a massive impact on the wider stock market as well. Now, there's actually an interesting link between AI and the trade war, because there's been some rising tensions between the US and China when it comes to AI. Obviously, both countries, both superpowers, are in a race to develop AI, and there has been retaliatory actions already trying to hinder the growth of AI in both economies. I'm not going to go into detail on this particular show, but this is likely to accelerate as we go through to 2025. And if it does, that starts to disrupt supply chains. That could have an impact on those AI stocks. Another theme that we are probably going to be talking about next year is the divergence in central bank policy. So the speed at which some of them will be cutting rates, and also some of the central banks that might not be, or in the case of the Bank of Japan, possibly raising interest rates. That will have a big impact on currency markets, but it is also likely to have an impact on investment markets domestically, where typically those stock markets where the central bank has been most accommodating in terms of monetary policy tend to do better than those where the policy is more restrictive. It's not a guarantee, but if you look at history, that tends to be the case. So don't be surprised if we talk more and more about central bank policy and the difference between the different central banks' policies throughout 2025. Now, bond investors might be thinking, well, what about bonds? Well, interestingly, if we look back at 2024, it was another challenging environment for bond investors. So if you're a UK investor, if you invested in high yield bonds, so you took more credit risk, you actually did fairly well and you would have outperformed cash. So the average high yield bond fund was up about 9%. But if you invested in UK gilts, for example, then you would be sitting on a loss. And as I make this, they are down between 2% for a typical UK gilt. But if you're looking at index-linked gilts, then it's down around about 6.8% as we make this show. That just shows the duration risk of those particular products. So index-linked gilts have a longer duration typically, so they're more sensitive to changes in interest rates or changes to interest rate expectations. So the message was that 2024 wasn't a great year for bond investors, and you would have only outperformed cash really if you'd invested in high yield bonds. So whether that will still be the case in 2025, we'll have to wait and see. But there's still going to be a challenging environment where we've got this uncertainty around inflation and interest rates, which is going to continue into 2025. I'll just mention the 10-year US Treasury yield, as that's a particular indicator a lot of people focus on. At the start of 2024, we saw it falling, but actually the general trend is it's fallen, but not as much throughout the year as people had predicted. So we're up over 4% at the moment, and we've seen periods where it's declined, then it's risen again and then declined. So as yields on bonds and treasuries rise, it means the capital value of those falls. So as a bond investor, when you see yields go up and you're holding them, it probably means that the holdings within your portfolio within bond funds are going down. Now, that uncertainty in 2024 is probably likely to continue into 2025. And the last few years, we've seen people say that bonds will be back, and it hasn't happened. So I'm not sure we can be as bold this time around, which again moves me nicely onto the whole 60-40 portfolio. So 60% equities, 40% bond portfolio, which is actually probably the most typical balanced mix out there. Now, one thing to point out, as I talked about gold, you should diversify your portfolios, and there is more to life than just bonds and equities. And we saw difficult years for the 60-40 portfolio in 2022 and 2023. And it led to many people saying, is the whole 60-40 portfolio doomed, and is it now never going to actually perform in the way it had done in the past and provide that diversification? Well, we'll have to wait and see on that. But one thing to point out, there is some analysis that I've seen that suggests that when bond yields, and we're talking about the 10-year US Treasury yield in particular here, is above 4%, it does create a favourable environment for the 60-40 portfolio, which might be at odds as to what you might think. You might think that you want to see that Treasury yield come down to the lows we've seen in recent years. But actually, even if the 10-year US Treasury yield remains fairly elevated around the 4% level, it gives it an environment where equities and bonds play nicely together. And it means that you don't underperform maybe a pure 100% equity portfolio as much as when we see the 10-year Treasury yield fall way below 4%. Don't dwell on that. The point is that we could see a good environment for the 60-40 portfolio in 2025. So it'll be interesting to see what happens. And when we get to this time next year, we can look back and determine, well, was that research actually correct? The other thing to probably mention before we wrap up, the US dollar. Now, the general consensus is that perhaps the US dollar will continue to rally as it has done since the US election result. But the one word of caution I will throw out there is that after the 2016 election, if you remember, Time magazine did that now infamous front page where it had the strong dollar because it had obviously surged. We then had a huge slump throughout the next year, and it was actually nicknamed the Trump slump. So don't assume that we're going to automatically see the strength of the dollar continue. There is a precedent where it didn't, and actually the US dollar strength went into reverse and started weakening. So the reason why the dollar is important is because, well, if you tend to get that right, you tend to get the direction of most assets right. A strong dollar tends to be a bit of a headwind for US stocks. It's also a headwind for things like emerging market assets as well. So I will, of course, cover that in more detail in the market updates I do each month throughout 2025. So there you go, Andy. That's a bit of a whistle-stop tour. I know what will happen. I'll listen back to this show and I'll sit there and think, I forgot to mention that particular theme. But as I mentioned earlier in the show, this is based upon some research and an article that I carried out for 80/20 investor members. So you can always take out a free trial and read the full piece at your own leisure.
Yeah, so that is a whistle-stop tour of what you expect might happen in 2025. And for any new listeners, just to remind you that this is a slightly different show to the normal show that we put out. We usually cover 3 main topics throughout the podcast, and we'll continue to do that throughout 2025. And obviously, if you go back through the feed, our previous episode was highlights of our best shows throughout 2024, just to give you a flavour and a taste of what this podcast is all about.
Yeah, and we don't always focus on investing. It typically is only one of the segments we do each week, just to give the podcast a real breadth of content.
Okay, so that's it. We are done for the podcast this week and indeed this year. So we hope you've enjoyed the podcast we've been putting out this year. We're doing lots more next year as well. There are lots of places you can support Money to the Masses. Please do that if you can. Of course, we've got the YouTube channel. Please do subscribe, and you can watch the videos there too. We've got all of our socials that you can follow us on to. We have also got a Facebook group where you can put questions to our community. That is facebook.com/groups/Money to the Masses.
And of course, don't forget to sign up to our weekly newsletter that comes out every Sunday at 10 a.m. that covers all of the stories that you need to know about that impact your personal finances. You can sign up to that at the usual place, moneytothemasses.com/weekly-newsletter. So Andy, I think that's everything for 2024, except to tell people, do please also leave a review for the podcast, because that does really help us. And it is incredibly motivating as well. So Andy, until next time.
Until next year.